When you boil it all down, every single financial transaction, whether it's you lending a friend $20 or a massive multi-billion-dollar corporate loan, it all comes down to one simple thing: a promise. One party gives money now with the promise that the other party is going to pay it back later. That simple idea, it's the absolute bedrock of our entire financial world. So that leads to the big question, right? What happens when that promise gets broken? What happens when a loan just isn't repaid? This isn't some small hiccup. It's one of the most fundamental challenges in all of finance. And today, we're going to unpack exactly what that means. So let's start right at the beginning with a promise itself. Okay, so a loan is really just a simple deal. A lender gives out some money, we call that the principal, and in return, the borrower promises to pay all of it back, plus a little extra on top for the privilege of using that money. That extra fee, of course, is the interest. Seems straightforward, but hiding inside the simple agreement is a massive amount of potential risk. So what if that promise is broken? Well, in the world of finance, this isn't just a bummer. It has a very specific name: credit risk. This is the core risk a lender is signing up for, the chance that they just might not get their money back. So let's zoom in on what it actually means to officially break that promise. In financial terms, this is called a default. Simply put, a default is when a borrower fails to make a payment they were supposed to make. That's it. This is the moment that promise is officially shattered. And for the lender, it's when that abstract idea of credit risk suddenly becomes a very real, very tangible problem. But, a default almost never happens overnight. It's usually more of a process, a slow slide. It might start with just one overdue payment. That often triggers a grace period, giving the borrower a little extra time. If the payment is still missed, then late fees start piling up. And it's only after all of this that a loan is typically declared to be officially in default. Now, in the most serious cases, a default can lead to bankruptcy. And get this, the word itself has a pretty cool story. Bankruptcy comes from the old Italian term Banca Rotta, which literally means broken bench. See, back in Renaissance Italy, money changers worked from benches in the marketplace. And if one of them couldn't pay their debts, their bench was literally broken in half, a very public, very clear signal that they were out of business for good. Okay. All this talk about defaults and broken benches might sound a little bit grim, but here's the good news. Our financial system isn't just running on hope. Over hundreds of years, we've developed some really clever safety nets to manage this exact kind of risk. We're going to look at the three big ones: collateral, insurance, and regulation. Each of these plays a super important role in keeping credit risk from spiraling out of control. Let's start with collateral. Collateral is a really simple but powerful idea. It's basically an asset that a borrower puts on the line as a guarantee. The perfect example is a car loan. The car itself is the collateral. If you stop making payments, the lender has the right to come and take the car to get their money back. It's a backup plan that's built right into the loan, and it turns the debt into what we call a secured debt. But here's a twist. What about when you're the lender? Every time you deposit money into a bank account, you're essentially lending the bank your money. So what protects you if the bank defaults? Well, that's where insurance comes in. In the United States, for example, the FDIC insures your deposits up to $250,000. It's a government guarantee, and it means that even if your bank fails, you'll get your money back. That's absolutely critical for maintaining public trust in the whole system. And finally, we have regulation. The best way to think about this is to imagine a professional sport, say football or soccer, but with no rule book and no referees. It would be total chaos, right? Well, that's what regulation does for finance. It sets the rules of the game to try and keep everything safe, fair, and equitable. These rules are there to prevent cheating, to protect the players, which in this case are consumers and investors, and to make sure the game itself doesn't just collapse. Okay, so we've talked about the problem of default, and we've covered the system's safety nets. Now let's see how all these ideas come together in one of the most important financial instruments in the world: bonds. So what the heck is a bond anyway? Think of it as a formalized, tradable IOU. An investor lends money to a huge entity like a corporation or even a government. But what makes it so special is that this IOU can be bought and sold on the open market, just like a stock. And as you can probably guess, the credit risk, the chance that the original borrower won't pay it back, plays a massive role in what that IOU is worth from one day to the next. Just take a look at this table. It shows a typical payment schedule for a U.S. Treasury bond. See those regular fixed payments happening every 6 months? Those are the interest payments, but in the bond world, we call them coupon payments. Then, on that final date, the maturity date, the investor gets their very last coupon payment plus their entire original investment back. It creates this really predictable stream of income, but the whole thing hinges on that one crucial promise, that the borrower won't default. To really get what makes a bond so different, it helps to compare it to something you might be more familiar with, like a certificate of deposit or a CD. A CD is pretty much just a savings account that you agree to lock your money in for a set amount of time. A bond, on the other hand, is a tradable asset. Its price fluctuates on the market, and you can sell it to someone else long before the original loan is due to be paid back. That ability to trade the debt is really the key difference. So we get it now. We understand the risk of a broken promise, of a default, and we've seen the safety nets designed to manage it. But this all leads to an even more fascinating question. How do markets actually put a price on that risk? How much more interest should a risky company have to pay compared to a super safe government? Understanding how risk is managed is one thing, but understanding how it's priced, well, that's the key to the entire financial universe.